So while we have been in a bit of a crypto winter, this next company has definitely doubled down and raised the stakes and seems to be doing pretty freaking well. So let's hear it from him. Please welcome to the stage co-founder and executive chairman of Animoca Brands, Yatsu, and your moderator, Lucas Matney. Warm welcome, please.
Hey, everybody. Well, we've talked a good amount about crypto this year because it's kind of a big thing lately. We haven't talked as much about NFTs. So you know quite a bit about NFTs. Your company is worth $5.9 billion, or $6 billion? $6 billion these days?
Give or take.
Okay, all right. So to people who love NFTs, NFTs make a ton of sense. To people who don't understand NFTs, they either maybe aren't sure how they feel about them or they hate them. How much time do you spend thinking about the NFT skeptics?
I mean, I don't think we spend too much time thinking about the NFT skeptics because we're just busy building. But I think our perspective on this is that, particularly in the US, a lot of people who don't like NFTs, it's a reflection, I think, more to do with their views on capitalism. So in other words, the same people, particularly young people, like in gaming, for instance, they in America tend to lean more socialist these days, right? Capitalism hasn't worked for them as well. They look at basically sort of crypto as another tool for the rich to get richer. NFTs is sort of encapsulated within this. When you basically have NFTs, they see a Bored Ape, and so it's a little bit like...
I can't buy a house, but they can buy monkey pictures for $3 million.
Right?
Yeah.
It feels just really unfair. Now, by saying that NFTs are Bored Apes, it's a little bit like saying the entire car industry is Lamborghinis. That's not true. But they don't understand the use cases in the same way in comparison to Asia, for instance, where it's thriving and growing really fast, because most people in Asia don't have a sort of issue with sort of owning things in that sense. So digital property rights is also a bit of an alien concept. The idea that I can actually own the derivative of my data rights.
Okay.
Right? That's something, again, that needs to be explained. I mean, we appreciate our physical property rights, and we know that physical property rights are attached to our physical freedoms, economic freedom and freedom to transact. But we don't appreciate that digitally because we have been basically in the walled gardens of the Facebooks and Apples and Googles for such a long time that we think that's normal. So I think there's a little bit of education that has to happen as well. But I think it ultimately boils down to this idea of inequity. I think that is a big reason why people dislike NFTs in this part of the world. In Asia, I say this, is that the American dream is actually much more alive and well in Asia than it is in America. And I think that translates a little bit into the thinking of money. I think it's also a value thing, right? Appreciating non-fungible tokens is for people who are more liberal, perhaps, and more capitalist in their thinking, in comparison to, basically people who might think more in terms of stronger socialist environments and more control, where they're accepting of central control, for instance, where they think that's the right approach.
Doesn't it? I guess it also feels like an open internet. If you're token gating a lot of experiences, that can kind of lead to a negative, more closed internet down the road, potentially.
Well, I think the main point is not so much that when you own an NFT, that in itself becomes an exclusive access. It's the freedom to transact from third parties. So, for instance, if you own a Bored Ape or land in Sandbox, the freedom of someone else outside to say, oh, you own land in Sandbox, let me offer you a service that is useful to you. So in the gaming context, for instance, imagine, a thought experiment, that Fortnite skins were actually available as, on-chain. Someone else around the world can open Fortnite Fashion Week, and they can basically just do this without actually having to seek permission from Epic to do so. And the composability of that actually is what makes it thrive and grow, because I can now have access to a Fortnite customer base, and I can actually grow this way. This is, by the way, how the physical world works, right? The fact that we have physical ownership, decentralized physical ownership of cars and the millions and millions of users is the reason we can have Uber and Lyft and car wash companies and people who design baby seats and leather seats and all these services.
Yeah.
The economic activity around the ownership of cars is much bigger than the sale of car itself. Right? And that's how we think NFTs are going to grow and proliferate.
I mean, we'll move on from this, but I'm curious right now, I think a lot of people talk about I understand NFTs if I talk about, I can buy a gun or a car in this game, and then I can take it into a different game. But I'm like, those game publishers are not going to work together, and someone who makes art for one game is probably not going to let another company do it. And that's at least how, when I think of the big American game publishers, it's probably how it's going to work. So I guess, does that, throw a wrench in that, or is that kind of a, does that not matter to you?
So if you're if you own an NFT, there is a license agreement attached to it. If the license agreement, and this is what happens with Bored Apes, for instance, or Cool Cats, or Land and Sandbox, you own that. And so you have the freedom to move it around and transact as you would with physical property. So that's the whole point about digital property rights that NFTs represent. If it has restrictive license agreements, then you can't do that. But here's the point. If you actually own it, a third party can offer you a service. I actually also know where the asset sits. I can reach out to you.
Sure.
So what it means is that ownership of content becomes a platform of growth, which is a threat to the central platforms because I'm no longer going to the App Store to find content. Content comes to you because you have a Bored Ape. So let me offer you a service, for instance, that we see today. Or you own Land and Sandbox. Let me come to you and offer you a special service just because you own land and I can maybe build a service for you. So that's where it sort of flips upside out. In the classic gaming sense, assets only existed in games to support the game because the game was what was monetized.
Yeah.
In Web3 gaming, blockchain gaming, actually the asset becomes the center of the experience. And games exist to support the assets in and of itself, which is kind of how the physical world works.
Well, we got deep into stuff very quickly because, I love this stuff. But I do, we've had a few people on the crypto, from the crypto beat on the Disrupt stage so far. I don't think any of them do quite as much as you do and have as many projects. So, Animoca Brands, what exactly is that and what's contained inside of it?
Okay.
Like, what is your job?
I'll try to make this really fast.
Yeah.
So Animoca Brands has been building in the NFT, I guess what we call digital property rights space for the last 4 or 5 years, so we're very early. We were one of the first money into things like Axie Infinity, OpenSea, Dapper Labs, Wax, Decentraland. We acquired the Sandbox. Today we have over 380 companies in the group, in the portfolio. 30 of them or so are subsidiaries. The rest of them are basically subsidiaries. We also run, as of last year, we also had an NFT accelerator, incubated 63 companies in the space. So we're all about pushing basically sort of decentralized digital property rights. We are a global operation. We're actually an Australian company, although we have a headquarter in Hong Kong. We have offices also in New York, LA, and San Francisco. Actually, our largest operation is in Argentina because of the Sandbox, so we're quite international. And we're pushing almost 1,000 people right now, which is still fairly small in comparison to the big tech companies. But obviously, from our perspective, we think that the Web3 is the next iteration of the internet, and digital property rights and the benefits of all of that is what we believe so much in. So the result is that we make many of these investments out of our balance sheet. So we don't have a fund, so we're a little different that way. Not only does it allow us to have a long-term lens, we look at the network effects that can be generated from these investments in ecosystem terms rather than in return terms in terms of the equity. So for instance, when we made our first check in OpenSea, which was very small valuation back in 2018, 2019, it wasn't because we hoped that OpenSea would be, a decacorn.
Yeah.
We did it because OpenSea had, lots of NFT, relatively good NFT volume, and we would help push that, and we would have our own products sell, and every company we invest in could sell on OpenSea. So we thought about the economic impact, right? So for instance, we're also big investors in various gaming guilds. Gaming guilds in and of itself may not appear to be the best kind of investment, but they drive customer adoption. They bring growth to the ecosystem. So we hope for a multiplier in economic activity rather than in pure return cycles. The fact that the market grows and we have returns in our equity and our tokens is obviously been a big benefit to us, but that wasn't the original reason we made all these investments.
Gotcha. So I guess looking at the kind of crypto venture capital ecosystem, I get a lot of emails on various announcements from companies raising money. I get a lot of emails about Animoca. You guys have raised a good amount of money and you've raised a lot of different rounds.
Yeah.
But I guess, what makes it notable more recently, you guys have seemed to avoid the down round so far. Like, what do you think about the kind of general, crypto outlook for raising venture right now?
Actually, I think raising...
There's a lot of money out there.
There is a lot of money out there. I mean, if you look at just Web3 metaverse investments in just Q3, for instance, $1.3 billion was invested, just in that era. So,
Which was for you guys out of that number?
We were fairly modest. It was only about $100 million, right, in comparison.
Pocket change.
Right? No, but the point being is that it's a very vibrant and active space, right? Earlier this year, we did raise $350 million, but you could argue that was sort of at this sort of bull, right? But either way, the space is continuing to grow because people who understand and see it view it a little bit like the internet in like 2000, 2001. Right? So if you take a sort of medium to long-term horizon and you understand where the space is growing, it doesn't really matter what the valuation prices are right now. And in our case, we're unique because very few companies have our position in terms of not only investing in the space, but also building the space, like the Sandbox, the Phantom Galaxies, or what we're doing with Revv Racing and so on. We acquire, for instance, Web2 game companies, I guess you call them traditional games, and move them into blockchain games.
Okay.
And it creates a sort of multiplier in value because you can have capital formation in the assets of these games, for instance. And for some reason, we're still one of the only companies in the world doing that, and it's been a very successful model for us. And I think that execution is one of the reasons why maybe we've been able to continue to attract capital. From an institutional standpoint also, we have a very strong management level as well. So we are more institutionalized, right? We have now, strong CFO, treasury functions, basically management teams that has a very sort of deep experience, which is also, I think, another factor as well. When we look at fundraising, we actually don't look at it from a capital raising perspective because we actually have a fair amount of capital.
Seems like you got a lot of money.
Our token balance sheet is in the billions of dollars. Our equity is also worth in billions, so we don't necessarily need to raise capital. What we look at capital raising is building alliances, right? When you think about people playing blockchain games, particularly things like play and earn or play to own, these are things where people make money as a living, particularly in developing countries. So for that, you need regulation, legislation, and that kind of support. So we can't just sort of go it alone and hope it works. We have to basically build alliances, and one of the best way to build alliances is to bring in friends.
So you're not seeing VCs pushing for more aggressive terms just because the outlook is a little bit more.
Oh, I mean they're pushing. We just don't have to agree. That's all. Right?
What kind of stuff are people pushing for?
Well, so we are a bit odd because we only have one class of shares.
Okay.
So we don't have pref shares.
Okay.
And so that means basically what we do is we don't give anyone any particular sort of additional benefits. Normally, VCs will try to come in and ask for very preferential rights, which is how they get downside protection. That's understandable. Other cases, they want to push valuations, maybe warrants, right? But really, I mean, I don't think you need to pressure yourself. If you have a good business, then people will come to you. I think, you have to make a balance, though. Like, for instance, we could also take the other perspective to say we won't, do we want to take a higher valuation or unless we don't raise money? That's not the thing for us. It's more about bringing in the last round, Temasek, Boyu, and GGV, which are, especially for Boyu and GGV, this was their very first blockchain crypto-related investment ever. And that was important for us, not because, of the amount of money they put in, that relative to a balance sheet wasn't significant. It's the fact that we've now gotten a new major investment group that sort of manages billions of dollars, curious about crypto, seeing the potential. And if we can educate them, how much more money would they then invest in other startups that will seed the ecosystem, which we're beginning to see.
I'm curious, there have been maybe more on the crypto publication side, but some notes talking about what active users look like in the crypto world. They'll say like Decentraland has 30 people using the platform and it's worth X billion or something.
Yes.
For you guys, you've come out and said you have 200,000 monthly active users.
On Sandbox.
On Sandbox.
But actually throughout...
Is that your most popular game?
No, I mean the most popular one is Gamey, actually, or Benji Bananas. Those are the most popular ones. And there we have millions of users, right?
Okay.
And we're activating millions of wallets, right? So one of the reasons why people sort of talk about these numbers is because they look at on-chain transactions. So when you look at the numbers of Decentraland, or if you look at, for instance, Sandbox, what you're seeing is a number of trades that happens between land. But actually, Sandbox itself has 200,000 active users, creating hundreds of millions of dollars economic activity, almost like a small nation. But not every person is trading land, right? And that's kind of how the real world works. You don't buy your house so you can sell tomorrow. Some of us do. Most of us don't, right? We want to develop it. We want to stay there. We don't buy a car, so we sell it tomorrow. We might sell it in a few years if we want to, but we actually use it. And so that's the shift that's been changing as well in the space. You have to remember that crypto started as a financial thing, right? With Bitcoin, it was really sort of trying to solve a Wall Street, banking issue, rather than a sort of culture issue, which is what we see now with NFTs. So in the beginning, the whole crypto space was covered mostly by people who were there for financial reasons. That's why it had this strong speculative nature. But in the last year and a half, most people actually who joined came for culture. So for gaming, for art, for so on. And of course, some speculate, but most don't. So as that trend shifts, which I think is more natural, we're going to continue to see a growth in the space, but the speculative nature is going to continue to drop. And you can't remove it. I think it's necessary, but it won't be the majority of the transactions. And that's what you see right now. So of the 200,000 people that are playing Sandbox, for instance, only a handful trade, which I think is how the real world works as well.
Talking about Sandbox a little bit, so that's like a metaverse title, correct? Is how you?
Yeah, it's like,
phrase
think of it as Minecraft on chain.
Okay. I guess there are a lot of game studios out there that have titles that have tens of millions of monthly actives. Maybe they're on Web 2 platforms. There aren't any in the Web 3 world that have that many. But there are also companies that are saying they're building the metaverse. I guess, should you not have to say it if you actually are building the metaverse?
Well, I think there's different ideas of what the metaverse is. Right? I think a lot of people have arguments about that. Some people say it's VR, AR. So our interpretation of what we describe as the open metaverse is one where you actually have digital property rights. So we look at it almost like from a constitutional framework, right? Like just how George Washington said that you can't have basically freedom without property rights. We think the same is true with digital. You can't have digital freedom without digital property rights. So our perspective on the open metaverse is it has to start with that foundation of ownership. And that's where Sandbox stands out. You can create a metaverse in a closed wall garden, which is very feudal in construction. But the value you can generate in closed ecosystems can create natural network effects. The fact that I can own the NFT and have someone else build a game on top of it, or someone else provide a lending platform or a DeFi platform or other forms of network effects, that freedom to transact and that freedom to move the asset around, actually gives it more value and allows capital to form.
Well, you use the phrase closed-walled garden. So one of the things I'm always curious about is, can the metaverse model even work when the App Store model kind of tags on this big commission to most mobile titles?
I think eventually what will happen is that the App Store either has to fix its model or it will decline. Right? That's because if you look at, for instance, what happened with Axie and with Google Play, people, were downloading Axie and sideloading it. They just circumvented Google Play because from an economic standpoint, it just didn't make sense to basically share 30% of whatever they were making in the game as an end user, for instance. So it's about the value. So if you're all competing just on UX experience and convenience, then yes, right? The App Store and the 30% charge and everything might make sense. But actually, if there's an economic incentive layer that says you don't have to pay that commission, and you have to go somewhere else to do that, people are willing to do that. So eventually you're going to find basically a balance around that. The economic activity in a blockchain game is just so much more powerful. One of the things that happens is that the relative value per user can be in the thousands of dollars because you have capital formation, which in a Web 2 game is like cents on the dollar, maybe $1 or $2, right? Which means you must have like tens of millions of users to be a successful game. But in a blockchain game, you really only need hundreds of thousands of users, and you can be very sustainable. That has a few effects. The first one, obviously, is that you don't need to be on a platform to share 30%. The second one is that we think there's going to be a flourishing, kind of like a renaissance of, for instance, indie game developers who can basically just build games with more diverse content because we can finally build products for a niche audience that's willing to pay for it. And the problem about Web 2 is that we're all being treated the same. Your time on Facebook is valued the same as someone, in Africa, for instance. A musician on Spotify's time is, let's say pop music from, say, Justin Bieber is valued the same as a classical musician. That doesn't necessarily make sense, right? When we go to a concert, we're willing to pay a premium for one artist and maybe not for the other. We appreciate that. But then somehow in the Web 2 world, we somehow accept that one stream is like, a fraction of a cent, and that's okay. So what Web 3 does, it actually translates the real value, the 1,000 true fans, as it were, and you can monetize that better, which is more healthier for the ecosystem. It's more decentralized, so we think there's going to be a growth in really small, medium enterprises in the metaverse economy, which is healthier.
Well, you brought up Facebook, which triggered my mind. I mean, I guess so many people have, I don't think negative connotations is even the word in response to metaverse. It's just kind of comical, like they just laugh at it a little bit. Maybe, maybe not your friends. But when you think about some of that stuff, a lot of people take it more seriously because Meta is investing so many billions into it. And yet, their product kind of has raised eyebrows across the board. What do you think of Horizons? I mean, it seems like it's kind of the butt of a few jokes.
Well, it is the butt of a few jokes. But I mean, first of all, I think, and I don't know where exactly it totally went wrong. But, I would say that certainly Zuckerberg did get it right in terms of construction. Remember, he tried to put out Libra early days, right?
Yeah.
If you look at, for instance, Aptos and Miston Labs, these are basically blockchain projects that originally emerged from the team, from Facebook teams. So he understands blockchain. Right? He
doesn't get to build it, though.
He doesn't get to build it, though, right? That's one challenge. But he's in an interesting situation because he makes money from basically mining our time and attention. and by not releasing data to the open market, which in blockchain is kind of a complete sort of antithesis of what Facebook is currently building. So he's in an interesting quandary, I think. He's got a classic innovator's dilemma on hand. The other thing is when you build communities, you need a lot of goodwill. Right? When you're building, we think of the metaverse, the open metaverse, like Sandbox, for instance, or Axie Infinity, like building a nation. We measure it in terms of GDP, economic activity, not in classic profit and loss ways. When you're building a community, you need goodwill, right? If you're building a nation that has a bad reputation, that might be considered dictatorial, that has a track record of abusing its users or its communities, you tend not to trust it. And I think, unfortunately, I know Facebook has done a lot of good things, but it is often remembered for its bad things. And that's why it's really hard for them, I think, to build it out. They're really going to have to reinvent themselves from the ground up, I think, to be successful in the space. Just quickly on the economic side, yes, they said they're going to spend $10 billion a year to make the metaverse work. Well, here's the thing. $10 billion we think is not enough for Facebook to succeed. Because even today, billions of dollars is transacted in, actually much more when you consider fungible tokens in the open metaverse space, which includes all the tokens as well. That means that, and most of the value goes to the end user, right? Which means that why would I transact on something like Meta, regardless of its visuals, when I have to give more than half of it or half of it to the platform, when if I use Sandbox, I get 95% of it, right? It just doesn't make any sense for me to do that, economically speaking. And because billions of dollars of value is already generated in an open way, why would I surrender that value? So Facebook would have to spend a lot more to incentivize people to go into its platform. Maybe 4 years ago, there was, when the market was a little bit more fragile, they had a chance. But I think now they'd have to increase their spending significantly in order to actually make a dent in, the open metaverse.
We could probably spend 2 hours talking about the regulatory landscape and some of this stuff, but I am curious, you talked, we had Chris Dixon on stage on Tuesday, and I think one of the, it's not a Web3 meme, but it's just how venture capitalists describe it. They talk about if the early users of Facebook could have gotten a share of the profits,
Correct.
They could, something like that. But I mean, you have a token, but there's so many companies that are backed by US venture capitalists that don't have tokens, don't necessarily look like they're sharing the value with their earliest users.
Yes.
I guess, does Web3, if you look at something like OpenSea, how does that look any different than someone who buys something on eBay?
So, I think marketplaces themselves are important, right? And we're early investors in OpenSea, so obviously we wish them extremely well. However, they do have the risk of being commoditized, right? And we see this today, right? If you look at the marketplace competition, if you think about how LooksRare basically had a vampiric attack on OpenSea, they can do that because they can address the customers of OpenSea. That's the benefit of Web3. So Web3 has a naturally anti-monopolistic nature because the data frame is open. Just imagine if I could actually sort of have access to Amazon's database. How many companies out there in the world would suddenly start, basically attacking Amazon customers to say, hey, you bought this computer, let me give you a discount on this computer, right?
Yeah.
That's basically what you can do in Web3 that you can't do in Web 2. But I think the other area that is just sort of fascinating is that the end users themselves have that freedom to transact, right?
Are the advantages always going to flow to companies that aren't with U.S. jurisdiction or backed by high-profile venture capitalists that can't sit on their boards and can't wait for have to wait for the tokens to come around?
No, so it's not just about fungible tokens, right?
Okay.
And we're focused on NFTs, non-fungible tokens.
Sure.
The point is that when you go to Web3, it changes the relationship from effectively Web 2 is shareholder capitalism. You as a company get the benefits. As a shareholder, you get benefits as a company working for it. But you don't really share the benefits with your customer. You're a customer consumer. But in Web3, you become a customer owner, which means that you can share in the value that could be generated if the business happens to do well. That doesn't have to be in fungible tokens. That's maybe very sort of fluid and obviously has maybe more liquidity. But by owning land in Sandbox, for instance, or by owning a Bored Ape, for instance, if the community of Bored Ape makes it more famous, we all collectively, as owners of Bored Apes or land in Sandbox, can also benefit. It also creates a change in the relationship because now we have a responsibility to a set of owners as opposed to someone who's just consuming, where the relationship isn't the same. So I think stakeholder capitalism is probably the best framework to think about what Web3 does, which in itself then creates a more equitable form of capitalism, which I think is a problem in the world today, where much of the value is concentrated, whereas here the value can be shared across the usage. So the point about Facebook. whether it's a token or whether it's some form of digital ownership in the data that I generate on Facebook, if I have a way in which that could be valued, why shouldn't Facebook sort of share us a little bit on that?
Well, we're running low on time, but I guess the last thing I want to say is, or last thing I want to ask, we're in a crypto winter right now, or at least a bear market, yada, 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 but is this going to last longer than the last crypto winter? Is this going to be the same amount of time? How much is this going to, yeah.
So I think a few things. One, we think this isn't the same as the last crypto winter. The last crypto, if this is a crypto winter, that was a crypto ice age, right? Because Bitcoin was like $3,000, ETH was down. And that's also because the people building in the space were all mostly speculating in 2018, 2019.
Sure.
But now you have a lot of builders go in. Not just the funding that's going in, but the kind of people. You just have to look at where the talent is going.
When are things going to get back to normal? Give it a year.
Well, I think hopefully before in a year. We also think the cycles accelerate faster.
Okay.
And normally when there's economic hardship, more people tend to move into new paradigms,
Sure.
as we saw with COVID. So we think actually crypto will, and blockchain generally will be continuing to grow.
Cool. Well, we'll wrap it there. Thanks so much for chatting.
Thank you.